Welcome back, everybody. We're here for another episode of the Gold Standard Retirement Plan with Kevin Dauphinee, my esteemed host. Kevin, great to be with you.
How are you, James? Good to see you again.
Oh, I'm doing great. We just finished the Olympics. Did you get to watch any of those?
I certainly did. I really enjoyed the gold medal basketball game.
Oh my gosh, that was really exciting.
Which was reminiscent. I was texting my sons. In 2008, I attended the gold medal game in Beijing and to see Kobe and Dwayne Wade and LeBron and a number of the other stars against Spain. That was a really tight game that the U.S. pulled out. But Steph Curry really put on a show on Saturday afternoon, completing the gold medal win for the United States.
He got me nervous there, or at least the team got me nervous there in the last quarter. They came back, and then about 2 minutes left, he said, "Nope, this is my game. I'm taking it over."
Yeah,
it was awesome. It was really quite fun.
Yeah, that third three with about a minute left, he basically brought up from the hip. That was just astounding. And it was double teamed too, and he made it just nothing but net.
Yeah, it was really fun. Well, with the Olympics and all the international conversation, it's caused me to think about, at least in terms of retirement planning, it's caused me to think about diversification.
Yeah.
I think diversification is maybe one of the most talked about and maybe one of the most misunderstood concepts in retirement planning. I think we all understand that we need to have a diversified portfolio. Mm-hmm. But we don't necessarily understand what that exactly means, or much worse, how to do it.
Yeah.
So I'd like to talk about that today. Let's dive into diversification.
Sure.
What does diversification actually mean? When you're meeting with retirees, what does it mean in their retirement plans?
Not having all your eggs in one basket, just having things spread out in various investment forms. You know, one of the largest segments of a diversified portfolio is the value of your residence. So that's a significant piece. And further on in real estate, you could invest in income property. So that's another popular investment that's outside the securities realm. And then inside the securities realm, there's all kinds of real estate investments that are possible. In terms of traded real estate investment trusts, we don't particularly care for private REITs. And there are a number of other opportunity zones and things of that nature that more qualified in a alternative investment area. But in terms of traditional diversification, this goes back to the modern portfolio theory of, and this goes back to the 50s, and I think Markowitz wrote the original paper in the early 50s, having a number of different stocks. It could be 10 or 20 or 30. And when you look at the standard deviation of the performance of those stocks through the diversification, you could have 10 stocks, you could have 30 stocks, you could have 50 stocks, and the change in that standard deviation is very limited. What we've been doing recently for our clients is with a money manager that offers a separately managed account that has about 50 stocks, and it's been performing very well. And we don't know what tomorrow will bring, but the track record for the past couple of years has been completely astounding.
So there's talk about how to diversify within your portfolio from a stock standpoint,
Sure,
bond standpoint. But then there's also the aspect of diversification that comes from not having money in the market, and maybe you have some here, you have some there, and then you have some in the market, because the reality is, if you have a recession like we had in 08, 09, where just about everything goes down in the market,
Sure.
every sector, that you might have invested in, are you really that diversified in that kind of a scenario?
Well, one of the risk factors, there's many: inflation risk, market risk, sequence of return risk, so many different kinds of risks. But market risk exposure, as we learned in 2022, had an impact negatively on both stocks and bonds. There used to be a reciprocal nature to the performance of stocks and bonds traditionally. So 2022, we got shocked because of interest rates and so forth, and it's a bit of an anomaly. But diversification across various securities is important. Now, when I got started in this business, I was a big ETF fan, exchange traded fund fan, but my clients were not that well diversified, because if you say, bought the S&P 500, that's 500 best stocks in the United States. And this is John Bogle's concept, who I pretty much became an acolyte of his thinking. But if you, say, bought another exchange-traded fund that might have some mid-cap, say a mid-cap exchange-traded fund, that could very well overlap into the holdings of the S&P 500. That's possible. Off the top of my head, I don't know. But that's not necessarily diversified. So I think it's important to understand correlation. Correlation is okay. If correlation at one means if this stock goes up, this stock is going to go up too. That's a correlation of 1. If this stock goes up and this security goes down, that's a -1 correlation. So, and there's varying degrees, -1 to +1. So we want to make sure the correlation is calculable and measurable. So we don't try to be too much into one particular area.
Now, you've had a unique perspective into diversification, at least from a market standpoint, because you've also had a vast career background in global international business.
Mm-hmm. Yeah.
So as it pertains to that, is there strategies to diversify with international business or markets versus just stock markets here?
Well, the litany of risk include currency risk. So, if you have currency exchange risk, foreign stocks are sold as ADRs in the United States on the U.S. exchange. And then there's political risk. We'll run into that as well. At the current time, I'm not really bullish on the international market. If you look at the broad GDP of the major developed countries, the United States is kicking it. We're doing really well. We're very fortunate that things are doing as well as they are, driven a lot by AI, a lot by tech. So financial as well. A lot of positive reports from the major banks. Also, major U.S. firms have international exposure, so you're going to get that without the currency risk. So that's a great opportunity to have international exposure. Apple Computer is sold worldwide, so they're exposed to the international markets. So is Ford. So is General Motors. I don't specifically suggest to clients that we take positions in international funds or international stocks specifically. I think in our portfolios there are some foreign companies like Nestle, but that's about the limit of international exposure.
So on that note, as you're talking about what you guys do with clients, talk to me a little bit about how you guys determine someone's diversification and whether it's good or whether it's not good.
Well, that's our process. So when we speak to clients or prospects, we ask them, would you please disclose all of your accounts, your bank account, your mortgage statement, so we understand what that cash flow requirement is if they have a mortgage, and all of their securities accounts, investments that they have that are held away assets. For instance, if an investor had invested in maybe a son's business, for instance, that would be a held away asset. Just knowing where it is and so forth and what the risk is. What we will do is once we get all of those documents, we pull them together. We look at each and every individual stock that's in those portfolios, their cost basis, where they are in terms of gains or losses, and we can construct a risk profile on the entire portfolio. We do it by account and then by the entire portfolio. So now we've got a number, and that number goes from, say, 0 to 100. And if you're a 40-year-old with $500,000 in your 401k, you probably want to have a risk number somewhere in about 80. If you're a 60-year-old that's just planning to retire pretty soon, your number should be pretty close to 60. And if you're 80 years old, you probably want that risk number to be closer to 40. Now, an 80-year-old should still have some exposure to the market to account for inflation. But most of those assets for an 80-year-old should be locked up in safety. So that's how we look at risk and how we calculate it.
So once somebody has come to meet with you, mm-hmm. how should they approach diversification in their portfolios? You guys have determined where they're at, and we determined they need to be more diversified. Mm-hmm. How should they approach that?
Well, it's really not so how much the client or the prospect should approach it, is how we should approach it in terms of what is it that you're looking for. If I say I can project that you will receive 8% returns over the next 5 years, just projection, no promise, no commitment, no crystal ball. But on our historical average, 8% is the number that we come up with, because they are of such an age and we don't want to place them in too much risk. So how does that number sit with you? Is 8% great or not so great? And once we have that understanding, it's about the client's risk assessment. Where do they see themselves? I've talked to 80-year-old investors that just they put the hammer down. They really want to go. And I've also met 55-year-olds that say, well, I've done okay, and I might just put it all in the money market and take 5%. So there's a range, but it's all about how does an individual or a couple want to address lifestyle expenses going forward. What are their high cost discretionary expenses going to be, whether it's a wedding or a car for a child or a grandchild. So those are the things we have to take into account.
So let's talk about some of the common mistakes then that people make. This usually happens probably prior to them coming to you, and you guys are helping them fix those mistakes. But when you see a new client come in, you're looking at their portfolio, where do you see the biggest mistakes that people make or the biggest pitfalls that people make regarding diversification?
Primarily mutual funds. Mutual funds are not the friends of an investor, especially in retirement, because of the fees that are marketing and administration fees that are attended with mutual funds. So it could be as little as, say 0.3, 0.4%, but you don't want to give that up unnecessarily. Exchange traded funds, on the other hand, have a much less load, if you will.
So real quick, before we go into maybe some other mistakes, you talked about mutual funds and ETFs.
Yes.
What are the biggest differences between those, if you could talk about that really quickly?
Sure, yeah. Well, an exchange-traded fund is just that. It's traded throughout the day. So it is fully liquid if the market finds that to be an attractive investment. And it tends to track an index. So index ETFs are what we're talking about here. And there's not a lot of trading. So there's not a lot of trading volume that occurs inside that inside that account. And it tends to be more tax efficient. The mutual fund, the money manager of a mutual fund, is constantly trying to improve the performance of that account for net asset value, to boost the net asset value of that account. However, every trade has a ticket cost applied to it. So it may not be applied to our account particularly, but it's going to have an impact. So the movement from mutual funds to exchange-traded funds over the last 10 years is profound. Off the top of my head, I don't know what that proportion is, but it's significant. It used to be 90-10. It's probably more like 65-35 today, which is enormous. So I don't quote me on these percentages, but it's quite significant. And the average investor that goes onto the internet and looks at these kinds of pieces of information, they're making a decision on their own, with or without an advisor. Now, we don't do too much ETF work anymore, because fortunately we've migrated into a nice realm of high net worth clients that can qualify for these separately managed accounts where they own individual stocks. Those stocks don't cost anything once you buy them. That's it. So there's no cost to ownership until you trade it. So
right.
Rarely, if ever, incur short-term capital gain, which is ordinary income, as opposed to long-term capital gain, which is long-term capital gain tax. That's just how we operate it, and we're completely flexible at the opening. So when somebody comes in, we have a clean sheet of paper. So where we start to make qualifications is, what are these holdings? What is their expense load? What is their tax burden? We try to not only preserve, but enhance lifestyle over time. And how does that impact a family? Husband and wife, close to retirement, the kids are probably in college or just got out of college. So maybe that college expense is no longer a big deal, but there's probably a car involved somewhere. And there might be moving expenses for a job and stuff like that. So, I think freshly printed graduates from your university, those moving costs are going to be paid by their employer. But, you need drapes and, new sheets and linens and things like that. And mom is really on top of that typically, So, that's an unexpected expense or something that was possibly anticipated. But so those kinds of things come to bear. And we start to fill up that blank sheet with, here's your taxable accounts, your tax-deferred accounts, tax-free accounts. What are these expenses? How do we see those expenses moving forward in the future? And then what's that underlying tax burden?
So I think that's thanks for talking through mutual funds and ETFs, because I don't know that everybody knows exactly the differences, at least from the impact that they can have on your retirement plan and taxes and whatnot. What other pitfalls, what other mistakes do people make outside of maybe investing in mutual funds versus ETFs? What other types of pitfalls do people make around retirement planning?
Well,
or diversification?
It occurs to me from experience that many advisors place clients in inappropriate investments. And I've seen a number of retirees be invested in real estate investment trusts that are now completely illiquid, tying up tens or hundreds of thousands of dollars of retirement money that they may never see. I believe that placing retirees into real estate investment trusts, that's not the best way to get a gain. It's an okay diversification. If it's a traded REIT, has great reputation, solid cash flow for years. But I've seen a number of clients that have this is truly dead money, and that's to be avoided at all costs. Now, there are great REITs out there. Don't get me wrong. I'm not taking a swipe at the entire industry, because it can be a really great return, but it's a cautionary tale. The other thing is viatical insurance companies. You see these things advertised on television where they're going to buy your insurance company, your insurance policy, with the anticipation that at some point you're going to die and they'll collect that death benefit. Well, there's a classic case that's out in the market. I won't mention any names, but they went way too aggressive and left a lot of people holding the bag. So we avoid that stuff.
With that, share an example of how effective diversification can impact someone's retirement savings.
Well, there's asset classes and market sectors. So first, in the asset classes, there's cash is king. Start there. Always have a significant cash reserve. Now, folks will say, "Well, I want my money to earn." Well, you put it in a money market. It's completely liquid. It's 24-hour transferred into your bank account if it's set up correctly. So that's as close to ATM convenience as you can get. So then equities have been the means of beating inflation for centuries. So there's that. To diversify away from equities and have some stability, fixed income instruments, bonds particularly, and I would add annuities to that. I would add insurance products to that. As a fixed income, guarantees are part of an annuity. So there's that part, and then we get into derivatives, and derivatives are options. The most popular retiree option play is a covered call. If the security exceeds the value of the option, it triggers sale. So, but it's an income-producing opportunity that some people employ. I don't do very much of that, but it's available. And then there's the very traditional straddle. So this is an option play for beginners. I've toyed with this a little bit in the past. I don't do it anymore because it just takes too much time and concentration. But for a retiree that might be interested in that kind of thing, there are some very interesting options plays that they could do on their own. Wouldn't be part of our purview. So that's the derivative side. Then we get into the alternatives, which I'm studying more and more these days, particularly with oil and gas, which can be a significant tax advantage for for a client. So if you have say a high income year, so they get a bit of a severance, they get salary to a certain extent, and then these RMDs all coming out at the same time. So it's a really big number. So we're looking at opportunities to mitigate that through tax deduction from oil and gas contracts. There's opportunity zones are also tax advantageous. There are a number of other funds that are out there, alternative funds that are available. You have to be an accredited investor to participate, but these are ways to do that. And that's part of the commodity play, certainly the oil and gas side of things. Precious metals, we don't do much of that at all. I have a couple of clients that have precious metal funds. If they have actually ingots or bullion, that's held away assets. We don't touch that at all. Provide guidance if they want to move it from one place to another. Say their custodian is not the best. We'll find that resource for them.
So, wrapping up, what are the key main things that people need to understand about diversification and risk management in their portfolios?
Keep it simple. Try not to get out over your skis with complication, because it doesn't get you anywhere. If you look at Moskowitz and his breakdown of, okay, I have 10 securities, 20, 50, 100, 1,000 securities. The bang for the buck to get to 1,000 securities is not that much. The complexity is untoward. You just don't need that kind of complexity, because the money managers that are available, I am not a money manager, but the money managers that we use in our firm are extraordinary, really thoughtful. They're on the game every day. They're paying attention over the weekend. They just don't miss a beat. And they have a contingency plan where their lead person has somebody that's following along, so there's somebody always on top of these cases. And we create a structure that is appealing, comfortable, and places the client's mind at rest. We want to be able to de-stress the situation of investing. That's our goal. Create comfort for the client that they know that they're in good hands. And we never touch the money. All of it goes from institution to institution. But we come to agreement together where these are the various silos that we place these assets, and we can watch them grow together. Now, there will be corrections along the way. We definitely get into the fourth quarter of the year, and we will do tax loss harvesting. So those are the kinds of things that we do. And it's complex from our side, but what we want to do is boil it down to a single sheet of paper. Just one piece of paper, here it is. And we've been able to do that with looking at assets, income, and tax liability. And then we create a pie chart that shows the diversification all in one little sheet of paper. And that's our annual review.
So key is to keep it simple, and you guys help retirees to do just that.
Sure.
Well, I appreciate the time today, Kevin. I think that this is a really important topic. For our listeners, again, if you are feeling like maybe you're not quite diversified enough, or you're worried that maybe your portfolio is at risk of the different market scenarios, we invite you to schedule a time, meet with Kevin and his team, book a call at goldstandardwealthmanagement.com, and go ahead and like and subscribe to this channel so we can keep putting out more quality content for our listeners. Kevin, thank you again.
Thanks a lot, James. It's great to be here. It's a great topic. And it's a 15-minute call. It doesn't cost you much.
No, it doesn't at all. We'll see you on the next one.
All right. Thanks again, James.